Okay, so when we think finance, names like Goldman Sachs, JP Morgan, they spring to mind instantly. Big players.
Yeah, absolutely. Household names, almost.
But there's this other massive entity kind of operating more in the shadows, maybe, BlackRock. And they manage just an unbelievable amount of money, more than the GDP of nearly every country.
It's staggering, truly. And that's what we're digging into today, using insights from the book, The BlackRock Empire, The Hidden Power Controlling Global Finance.
Right. Think of this as uh, your fast track to understanding how this company got so incredibly powerful.
Exactly, because their influence stretches, way beyond just Wall Street. It touches global markets, government policy.
Even our daily lives in ways we might not realize. So, yeah, our mission is to unpack that. Let's pull back the curtain. Where does a giant like this even start?
Well, it's a pretty fascinating story, actually. Starts with Larry Fink. Ever heard of him?
The name rings a bell. Totally. Key figure, right?
Oh, absolutely. Back in the 80s, he was a real hot shot at First Boston, a pioneer in mortgage-backed securities, which were, pretty new then.
Okay.
But then, 1986, a big miscalculation in that exact market.
Right.
Cost the firm something like $100 million.
Wow. $100 million.
Yeah.
In 80s money.
Oh, yeah, that must have hurt.
Oh, yeah. Big time. It basically knocked him off the fast track there. A major setback.
So, end of the story. Clearly not.
Not at all.
Yeah.
Fink's resilient. He partners up with the Blackstone Group, starts a new asset management arm for them.
Ah, okay. So initially part of Blackstone?
Exactly. Started as Blackstone Financial Management. But here's the thing. It took off, grew incredibly fast.
Faster than Blackstone itself.
Eventually, yeah.
Yeah.
Within about a decade, it was so successful they spun it off. Independent company, BlackRock. And like you said, it ended up dwarfing its original parent.
Incredible turnaround. So what was their edge? What made BlackRock different?
Technology, that's the key word. Fink saw, really early on, how tech could fundamentally change finance.
What others were still focused on, the star fund manager, the gut instinct kind of thing. BlackRock was building something different, something systematic.
And that leads us to Aladdin, I assume. Sounds almost mythical.
Yeah, the name's evocative, isn't it? Aladdin. Stands for Asset, Liability, Debt, and Derivative Investment Network.
Right.
Basically, it was this revolutionary risk analysis system. Think of it like a financial superbrain, crunching millions of calculations all at once.
It's hard to even picture.
Yeah.
And Fink himself really believed in this data-first approach.
Absolutely. There's a quote from him, I think around 2009. He said something like, most financial pros are good at finding opportunities, but terrible at quantifying risks. We built BlackRock, he said, on the principle that you can't manage what you can't measure. That was their core idea. Measure everything.
So that tech advantage wasn't just nice to have, it was crucial.
Yeah.
Especially when things got rocky.
Crucial is the word.
Yeah.
Came 2008, the financial crisis hits. Lots of firms go under or get badly wounded. BlackRock, they not only survived, they thrived. Their risk management, powered by Aladdin, was just superior.
And that's when the government stepped in.
Exactly. The feds needed someone to manage the absolute mess, the toxic assets from places like Bear Stearns, AIG.
And they called BlackRock.
They call BlackRock. Huge vote of confidence. And honestly, a massive turning point for BlackRock's scale and influence. It put them in a whole different league.
Okay, let's zoom in on Aladdin then.
Yeah.
Because it sounds like the heart of the operation. You said it processes a crazy amount of data.
It's mind-boggling. Over 250,000 financial transactions analyzed daily. It monitors risk for assets worth, well, last I checked, over $20 trillion.
20 trillion.
With a T.
With a T. That's something like 7% of all financial instruments on the planet. Think about that. One system.
That's immense. And the potential impact if something went wrong with it or if it had biases.
Exactly. The systemic implications are huge. And it's not just looking at, simple stock data.
Right. You mentioned it goes way beyond that.
Oh, yeah. Aladdin pulls in data from everywhere, central bank statements, economic reports, sure, but also satellite images of shopping mall parking lots.
Wait, satellite images?
Yeah.
To predict markets?
Yeah, to gauge consumer activity, things like that. They build these incredibly complex predictive models trying to see shifts before they happen.
Yeah, it's astonishing. It really feels like global finance is becoming almost dependent on this single piece of tech.
That's not an exaggeration. It's
No.
not just BlackRock using it internally anymore. Over 1,000 other institutions rely on Aladdin.
Like who?
Big ones. Major central banks, sovereign wealth funds, the giant pools of government money, huge pension systems managing retirement funds for millions.
So the Fed, other big players.
Yeah.
Their clients.
Clients, users, yeah. Remember March 2020, markets going absolutely haywire because of the pandemic?
Oh, yeah. Scary time.
The Federal Reserve needed to step in, stabilize things. Who did they turn to actually implement their emergency bond buying programs?
Let me guess. BlackRock and Aladdin.
You got it. BlackRock and Aladdin, again.
It really paints this picture of a private company, sitting right at the controls of global finance. There was a quote about that, wasn't there? Blurring lines.
There was, yeah. A former Treasury official said something pretty blunt, like, when markets are in crisis, the Fed doesn't call Goldman Sachs anymore, they call BlackRock.
Wow.
And then he added, the line between public authority and private power has never been more blurred. That really sums it up.
It's kind of staggering. One company, one piece of software, so deeply embedded. But okay, BlackRock isn't just living in the abstract world of finance, right? Their reach extends into the physical world too, like housing.
Absolutely. This is where it gets very real for a lot of folks. After that 2008 crisis, with all the foreclosures, BlackRock saw an opportunity. They started buying up distressed single-family homes, thousands of them, on a scale nobody had seen before.
And not just flipping them.
Right.
They had a different plan.
Right. They weren't flipping. They were converting them into rental properties, becoming a massive landlord.
So we see this pattern again, using a crisis, leveraging their financial power, but this time in housing.
Exactly. And fast forward to today, well, by 2025, according to our source material, BlackRock-linked companies are basically the largest owner of single-family rental homes in the U.S.
The single largest.
Yeah.
Nationwide.
Yep. And in some specific markets, particularly fast-growing cities like Phoenix or Atlanta, their control is even more concentrated. We're talking up to 20% of the entire rental housing stock in some areas.
20% in major cities.
Yes.
That's market power. That has to affect rents, right?
You'd expect it to, and the research seems to bear that out. Studies found that in markets where BlackRock had a big presence, rents went up faster, something like 14% to 22% faster than comparable areas without that concentration.
So it's driving up housing costs.
It appears to be a significant factor, yeah. More demand concentrated in fewer hands, sophisticated pricing algorithms. It puts upward pressure on rents, makes it harder for tenants to negotiate, contributes to affordability issues.
And there's an algorithm involved in the rent setting too, isn't there? Not just buying the houses.
Yes, and this part is, well, it's pretty concerning. The book mentions internal documents talking about a housing algorithm designed for, and this is their term, tenant revenue extraction.
Tenant revenue extraction? That sounds clinical.
It does. Basically, using machine learning to figure out the absolute maximum rent they can charge and the perfect time to raise it, maybe factoring in when it's hardest for a tenant to move.
So it's optimizing profit by analyzing tenant vulnerability, essentially.
Yeah.
Wow. Okay, let's shift gears a bit, because we also hear a lot from Larry Fink from BlackRock about sustainable investing. ESG, environmental, social governance.
Right. Big push on that, especially in Fink's annual letters to CEOs. Very influential letters.
Yeah, I remember the headlines, climate risk is investment risk.
Yeah.
Stuff like that. Sounds positive.
On the surface, absolutely. It positioned BlackRock as a leader, pushing companies to think about sustainability. It made ESG a mainstream conversation in boardrooms.
But there's a but coming, isn't there? Is the reality more complicated?
There's definitely a paradox, a big one. Because while they're talking the ESG talk, their actual investment portfolio tells a slightly different story. Despite all the ESG funds and the climate talk, BlackRock is still one of the absolute biggest investors in fossil fuels globally.
Really? How big?
The numbers cited are huge, something like over $85 billion invested in oil, gas, and coal companies through their various funds.
$85 billion. So they're advocating for climate action while holding massive stakes in the companies driving climate change. That's quite a contradiction.
It is, and it raises questions, right? Is the ESG focus genuine transformation, or is it partly about positioning, about managing reputational risk, maybe even about creating new investment products to sell?
Or maybe trying to influence the rules of the game from the inside.
That's another angle. They've sort of become this private regulator. They announced they'd vote against company directors if climate disclosures weren't good enough.
And companies listened.
Yeah. Oh, absolutely. Boardrooms scrambled. So you have this private asset manager effectively setting climate policy standards for global corporations without any democratic mandate, you know?
Yeah, the accountability question again. Okay, let's widen the lens again. The book talks about the big three. That's not just BlackRock, right?
Correct. The big three refers to BlackRock, Vanguard, and State Street. 3 giant asset managers.
And together, their power is even more significant.
Massively so, because they often own large chunks of the same companies. Collectively, on average, they control something like 20% of every company in the S&P 500.
20%. Just
Yes.
the three of them combined.
Combined, yeah.
Yeah.
And in some major corporations, it's even higher, sometimes over 25%.
So think about that. Three firms holding a quarter of the shares in huge companies. They have enormous sway over corporate governance strategy.
Huge sway. Board elections, executive pay, mergers, acquisitions, their votes are often decisive.
And the really weird part is, they own big stakes in companies that are supposed to be competitors, right?
Exactly. That's the common ownership phenomenon. Take big tech. Apple, Microsoft, Google, Amazon, Meta, Facebook,
Yep.
BlackRock, Vanguard, State Street. They're almost always among the top 5, sometimes top 3 shareholders in all of them.
So the same handful of investors owns large pieces of supposedly rival companies. What does that do to competition?
Well, that's the billion-dollar question, isn't it? There's a growing amount of economic research suggesting that this common ownership might actually dampen competition.
How so?
The theory is, if your major shareholders own large stakes in both you and your main competitor, are you really incentivized to, say, slash prices aggressively to steal market share? Doing that might hurt the overall value of your shareholders' portfolio.
So it might lead to less aggressive competition, maybe higher prices for consumers, fatter profit margins for the companies.
That's the concern being studied, yeah. Across airlines, banks, pharma, tech, the potential impact is widespread. It potentially conflicts with the public interest in competitive markets.
Okay, so immense power through ownership. But BlackRock's role seems to have morphed even beyond asset management. The book mentions this idea of a shadow central bank. What's that about?
Right. That term really gained traction during the pandemic, though the roots go back further. Remember we talked about the Fed hiring BlackRock in 2020?
To run the corporate bond buying program, yeah.
Exactly. The Fed essentially outsourced a core central banking function, intervening in markets, implementing monetary policy to a private company, BlackRock.
Which seems unprecedented and ripe for conflicts of interest.
Absolutely. Think about it. BlackRock is managing the Fed's program, deciding which corporate bonds to buy potentially,
While also advising other central banks around the world.
and managing its own massive investment funds, which could directly benefit from the very program they're running for the Fed.
Were these conflicts ever really addressed?
It was discussed a bit, but perhaps not with the scrutiny you might expect given the stakes. The arrangement went ahead relatively smoothly.
And this wasn't a one-off government contract, was it?
No, not at all. They also managed the Thrift Savings Plan, the giant retirement fund for millions of U.S. federal employees. They advise sovereign wealth funds globally.
So all these roles combined, advisor, contractor, manager, it creates this image of an entity deeply embedded within the state but still private, the shadow central bank.
Precisely. And this hybrid role gives them incredible insight, but also potentially incredible influence over policy debates. They can advocate for policies like certain types of monetary policy or deregulation that directly benefit their business model.
A very powerful symbiotic relationship.
Yeah.
Okay, looking forward now. They're not resting on their laurels, are they?
Right.
What's this Aladdin 2.0 thing? Sounds like the next generation.
It is. Aladdin 2.0 is their big push into artificial intelligence, taking the original Aladdin concept and supercharging it with advanced machine learning.
So going beyond just risk analysis and data processing.
Way beyond. The goal seems to be an AI system that can not only predict market movements with even greater accuracy, but potentially shape them
Shape markets.
by identifying incredibly subtle patterns, correlations invisible to human traders, and executing trades based on them at lightning speed. It could potentially anticipate and front-run market trends, or even create them through its sheer scale.
If one AI is making decisions for trillions of dollars, what does that do to market stability, to transparency?
Those are the critical concerns. If investment decisions become concentrated in a proprietary AI black box, does that make markets more efficient, or does it introduce new, unpredictable forms of systemic risk? What happens if the AI develops biases or makes mistakes we don't understand?
Have regulators raised alarms about this?
There's definitely concern. The book quotes a former SEC commissioner who basically said we're building a system where huge economic decisions are made inside a black box that nobody, not investors, regulators, maybe not even its creators, fully gets.
That's a chilling thought. A black box running the economy.
It's a stark warning about where things could be heading.
So let's try to synthesize all this. BlackRock, what's the big picture takeaway here?
It's the sheer multiplicity of their roles. They're not just one thing. They're the world's biggest asset manager, yes, but also a critical tech provider via Aladdin, a major government contractor, the biggest shareholder in most major companies, a huge landlord, a key standard setter for things like climate policy.
It's an unprecedented concentration of different kinds of power in one private entity.
Exactly. And that raises fundamental questions about accountability, doesn't it? Who oversees BlackRock? Their oversight isn't really comparable to, say, a democratically elected government or even a regulated utility, but their impact is arguably just as large, if not larger, in some domains.
It really feels like a shift in how power works in the 21st century. Private actors setting rules, shaping markets, influencing policy in ways that are, well, often hidden from plain sight.
It's a profound transformation, and whether you see that as ultimately an opportunity for efficiency or a threat to democracy and fairness, that's the central debate.
It really is. So for everyone listening, the main point is just grasping the scale and the often unseen influence of BlackRock. It's not just abstract finance. It connects to the housing market, corporate behavior, maybe even the climate policies of companies you interact with every day.
Right. It forces us to think about where power lies today and how blurry the lines between public and private have become.
And thinking about the future, especially with things like Aladdin 2.0,
Yeah.
it leaves us with a pretty big question, doesn't it?
It does. What does it truly mean for society if we increasingly entrust critical economic decisions affecting millions of lives to complex algorithms? Algorithms that might operate in ways we don't fully comprehend, let alone control? What happens to human judgment, to oversight in that kind of future? That's something worth pondering long after this discussion ends.